Joining us on the show today is Greg Weldon at weldononline.com. And Greg, you recently did an extensive review looking at the state of the U.S. consumer. And as you know, last week we saw a huge plunge in consumer sentiment back to levels we haven't seen since 2011. This is important, of course, because consumer spending now drives a whopping 70% of the U.S. economy. And so if consumers sour on their outlook and a pullback on spending takes place, that means we are likely looking at a slowdown. So what is your assessment of this recent drop? Is this just a one-off reaction to the most recent surge in COVID cases, as many headlines suggest? Or in your view, is this the beginning of something more sustained?
I think it's a bigger picture tell. So I think it actually goes hand in hand with some signs, albeit early stage and somewhat peripheral, that the housing market's slowing down as well. I take the consumer and I look back at where we were 6 months ago, when I was the one pounding the table on these consumer stocks, have priced in the most rosy possible scenario for rebounding consumer demand, which we likely get in some kind of release of tension way. You hold the beach ball below the level of the surface of the pool for long enough, you let go, it explodes through. That's the rebound that we got, in the summer. Delta, Lambda, Theta Chi, whatever, is slows it down. But I sense a couple of things. Number one, fatigue over this whole COVID. Number two, you still have the level of disbelief. Number three, the fact that it's the most polarizing thing on the planet right now. And in this country, that's reflected by the simple fact that 50.2% is the fully vaccinated ratio. So you can't get it any more polarized than that. The point here in bigger picture terms is, does this thing continue to linger as a headwind? And if not, is what's priced into the market realistic in terms of the economic growth with a consumer that's wounded to some degree? I mean, there's a lot of consumers that are not wounded. So again, it's polarized. I think that's the way I should have led with this, because the most important thing is that polarization applies to people. And you see that in the New York Fed's survey of households specifically, where you see the people under, the bottom half of the income range are the ones that are hurting, the ones that see the highest prices for inflation, that feel the impact the most, that are borrowed. They've gone on a borrowing feeding frenzy. The numbers for May and June, it's lagged a month, the Fed's consumer credit numbers, were record. Both of them were records, and back-to-back a record, and quarterly a record, and, the whole nine yards, all right? So when you look at that fueling, being fueled by paper money that the Fed has printed, again, the question is, if the paper money runs out and you have a consumer now that's full, that you have a whole layer of the labor market that's still basically been decimated, is maybe never coming back, millions of jobs. And you have the lower half of the income scale, which of course ties into the lower half of the educational attainment scale, all right, which of course is what the Fed's mandate here is for employment. Why? Because they're trying to distribute money more equally, which means, trying to give that lower half of the income scale a stepladder to reach a higher level. But that is really difficult in terms of these kinds of policies. And to think that that's going to work and the expectations in the stock market are going to be met, I think is problematic, number one. And number two, the problem with that conclusion is trillions of dollars that are still floating around out there buying anything. So again, polarized, man. Everything is polarized right now.
Yeah, that's for sure. And you can even see that, when you drill down into the various numbers, whether it's consumer spending or whatnot. I mean, big separation between Republicans and Democrats on their outlook. So, it's just funny to see the level of polarization when you drill into the economic data and all the sentiment numbers as well. One thing that we've been looking at that's giving us a bit more caution currently is a potential peak in liquidity. We're seeing a peak in growth rates of liquidity here in the U.S. It looks like we're seeing a flat line in global liquidity, and this could spell trouble ahead for the markets. We've been raising some cash here, and just having some dry powder in case we do see a correction or at least some greater volatility going forward. What is your view on the liquidity outlook currently?
I think that's a great point, great observation. I think that we've been talking about that in the same vein as the consumer for a couple of months here. And let me propose something to you, because you have a peak in liquidity at a time when, if you look at the latest budget numbers that just came out for July, okay, public borrowing in a 36-month span, if you project it out to what the CBO and what is in these numbers, all right, combined with what we've already added, and this is only since last year, okay, 36-month period, public borrowing will exceed $9 trillion through the end of fiscal 2022. All right. When you have the Fed about to step back from the bond market, and you're going to pump out $9 trillion of public borrowing in a 36-month period, some of it's been done already, but most of which hasn't. That's problematic from a liquidity standpoint. Number one, you send interest rates kind of back to where inflation is right now. And of course, inflation, transitory. The year-over-year rate of inflation might be transitory, but people can be paying higher prices for stuff no matter what. So, and if you time that with the political situation, which I really hate to talk about, but it's not really, partisan politics at this point. It's the fact that you have a mess in Afghanistan. You have China already, the planning has already started. It started months ago. I was talking about this. The Chinese planning to build roads through Afghanistan, through Pakistan, that will connect China to their, resource areas as far away as Africa and the Middle East. These are the things the Chinese are thinking about. And when they see the weakness here that's been displayed by the U.S., not only as it relates to Afghanistan, but also, and maybe even as importantly, the weakness related to energy and the weakness in the sense that Biden dissed kind of the younger generation of the Saudi Arabian royal family, the guys who basically run Saudi Aramco, in his second week of office. And now he's on the tape all but begging OPEC to produce more oil because gasoline prices are rising. Well, guess what? When you disinvest from petroleum companies, all right, and you haven't built a refinery in this country for God knows how many decades, all right, and these companies now indebted with low share prices, not a lot of liquidity, to cycle back to your liquidity question, well, of course, refinery maintenance is really expensive, man. And if it's not done, you're going to have shortages. You could see gas prices double digits in California, let alone the drought we have. Let alone that Lake Mead, you're talking about Lake Powell, you're talking about the lowest levels in the Colorado River system, ever, 40% of capacity. They just started rationing Lake Mead literally yesterday or today. I don't know exactly when that took place, but this hasn't ever happened before. You're talking about 18% of Arizona's water supply just disappeared. All right. You have one of the worst droughts in terms of the land mass categorized as under drought in history. All right. I mean, oh, my God, you have a situation where there was no action on any of these things. And I get back to Afghanistan, I get back to China, and I get back to Taiwan, because we know they have been messing around in the South China Sea ever since Biden took office. They've messed with the Philippine Navy. They have messed with the Malaysian, Taiwanese airspace. I mean, there's a lot going on there. And I think when the U.S. looks weak in Afghanistan, this is going to be the efficiency of the U.S. military, operation these days under Joe Biden. Man, you don't think China's chomping at the bit to jump all over this kind of stuff, let alone make a move on the dollar where they, in cahoots with Saudi Arabia and Russia, a benchmark crude oil priced in renminbi based on the Shanghai Futures Exchange. I mean, there's a lot could happen here, man. So when you want to talk about liquidity peaking at a time when really everything else is intensifying. Now, the problem is, and you mentioned it before, not to make a long answer longer, but it really is a good answer if you tie it all back together to the perpetual need for this liquidity, which you mentioned before. It's like it is a mathematical conundrum now, because each next wave of deflation, you have to print so much more money to get the same bang for your buck. Are we at the point where it doesn't work the next time? That's the big question. I don't know. But this is what gets me up every morning at 2:00 in the morning, all excited to sit at my desk for 18 hours a day.
Yeah. You just have to be printing bigger and bigger amounts. I mean, obviously, we saw that with the COVID crash. I mean, we just saw insane amount of monetary printing, fiscal stimulus, just to try to stave off worst case scenario. So if we do really start to see a big retrenchment in consumer spending, again, 70% of the U.S. economy is now based on personal consumer expenditures, based on the consumer. So that's a massive part. If we see a pullback in spending, which consumer sentiment this last week, big plunge back to 2011 levels. If that is something that is sustained, if this is more cyclical and not just a one-off reaction to the recent Delta surge, then that does signal that there's probably a slowdown ahead. And I think that from the overall assessment from people that we've been speaking with on our show and the data that we're looking at here, and tell me if you disagree or not, but we are looking at a 2022 slowdown, and it's likely not to result in a recession, double dip recession, unless we see some type of major exogenous event, of course. But 2022 slowdown is baked in the cake now at this point. And the big question is just how fast the Fed is going to be moving on the liquidity side of things with tapering, if that's going to be taking place, earlier than expected, if that's going to be a 2022 story, and what the impacts on the market are going to be. Those are some of the big unknowns that, of course, we're watching.
Yeah, I mean, in terms of the consumer, again, I think it's a bifurcated consumer. So that's, you're going to have a situation, I think, where the economy is even stronger without the support of liquidity, assuming that money has been absorbed. And the Fed has actually done a lot of studies on what consumers actually expected to spend versus save versus use to pay down debt. And most of the data shows that that's largely true, but the data also shows that consumers borrowed a lot at that time frame too. So, they've started increasing their debt again, which of course is both good and not so good, depending on, how you want to look at it longer term. But again, I think that one of the things we kind of tend to forget is before COVID, really fourth quarter of 2018, you saw the rollover. All right. You saw numbers in Germany all of a sudden sour. You saw the numbers in the US were headed south kind of, even into the fourth quarter of 2019. So COVID accelerated, in my mind, something that was kind of already on the table. The question is, have we worked through that yet, even given COVID? And I'm not sure the answer is yes, because you've lost a lot of growth. They talk about employment. Well, we need to get, the Fed's talking, another 900,000 and we can start tapering and so on and so forth. But guess what? Of course, they're going to taper. And of course, at first, the market's not going to mind until you got $9 trillion of public borrowing to be done. Then the market's going to mind. And then you're going to have a problem. And then the public's going to mind. Then the Fed's going to have to do something again. So you can create a scenario where this all does kind of play out by the end of 2022 when the Fed is thought to begin to start to think about hiking. Maybe it's hiked once. Maybe it's first quarter. Maybe it's second half of 2023. The pricing's all over the place. But I mean, you could make a solid case, and somebody's brought this up the other day, and I don't disagree with this. I don't think this is the top probability case, but it's a pretty good one, that the Fed never gets to the point where they raise rates.
The Fed hasn't even admitted that in prior papers, that we're probably looking at protracted rates and bouts of being at the zero bound. So, we could say that it could just be a matter of tapering, big market reaction, and then they don't raise rates, or it just takes a really long time. So that's definitely something to be mindful of as a potential outcome. I agree. So it sounds like, you are viewing this recent plunge in consumer sentiment by the University of Michigan survey as something that is more than just a one-off event. It's probably a bigger tell here on inflation, as you said, transitory and really high year-over-year terms, but we're likely looking at something that's a bit more longer lasting here. That's what we're positioned for, higher than average structural increase in inflation longer term. How does this relate to the commodity outlook? Because, we saw a big surge in commodities for the 2020 bottom. A lot of investors rushed into commodities. Some people are saying, there's still a very good long-term case here for the commodity sector. Obviously, we've seen some weakening more recently in copper and other areas. Gold and silver got hit pretty hard last week, I believe it was. So what's your take on the overall commodity outlook?
Well, you posed the question very well. I mean, it really is a sector by sector thing right now. And a lot of that has to do with the rebound in the dollar. You actually have the gold adjusted value of the dollar just made a significant technical breakout to the upside. This is a function of the fact that, we're in a lot better shape than a lot of other places. When you look at Europe and when you look at Japan in particular, and you have, two out of the three central banks, being the ECB and the BOJ, basically just told us they could ease again. So, from a rate differential perspective, which a lot of times is a major driving force in the currency markets, the dollar rate premium has been expanding. and expect that to continue. That lifts the dollar, and frankly, I don't think Powell has a problem with that now, because in the past, that probably would have provided some kind of issue for the Fed had it been a sign of weakness in emerging markets, where maybe there's a deflationary whiff coming from that. Right now, the Fed wouldn't mind a little currency disinflationary, against the tide push that might soften this inflation, which I think I think this is a more rapid increase to rates that they didn't expect to see. So, and of course, we said you could see rates, 4 up to a 5 handle in CPI, but I have to say, we didn't expect that to happen that quickly, all right, because it's so broad based and it is so embedded, like you said before. In terms of the commodities, the ones that are more sensitive to the dollar, the ones that are kind of slowing down or rolling over even, all right, gold and silver. I don't want to say gold and silver are vulnerable here, but you might get cheaper prices to make a later dated purchase. All right, let's put it that way. I think longer term gold and silver are fine, because the ultimate game is still going to be dollar depreciation, on the next wave, whenever that comes. But that could be an interim of time here, and that could be bad for the gold bulls. I would say that base metals are both ways. Base metals are kind of the bastard child of commodities, because they have this dollar weight on it, but they have great fundamentals, and particularly tin and nickel, all right, to a lesser degree copper. Even aluminum, which had been the black sheep all of a sudden in the base metal complex, has performed very well, looking to break out. Zinc as well. So I think base metals have a longer term positives, also have some dollar risk, although I think not as deep a risk as do the precious metals. I love the agricultural commodities. I just love them. They're rallying on autonomous, bullish supply-demand fundamentals, long-term in nature. Major declines in ending stocks of a variety of commodities, to where stocks to usage ratios are back to lower levels, and they have rallied in the face of a dollar that might have kept them at bay. Part of the reason is they've underperformed, so they have some room, relative to where the CRB has moved against the dollar. But I think you have a lot of bullish cases. Just did an ag special yesterday, 60 pages, just ripped apart the USDA's crop report from last Thursday afternoon. It was a fascinating report, a lot of changes and a lot of things you don't normally see the USDA do. It was really crazy, some of the things that the USDA did in this report. I'd love to give it to any of your listeners, just to come find us on our website, and we'll be happy to give you that report. I don't want to give away the end surprise on what the real significant positions are in some of the food / agricultural soft tropical commodities that I think are the next big wave bull markets in the commodity sector.
Well, Greg, with that said, as we close, would you mind telling our listeners the best way to get their hands on your excellent research?
Sure. You can come to the website, weldononline.com, and sign up for a free trial if you've never had one before. If you want to get the special, you could email us at sales@weldononline.com, and we'll set you up with that. And, I would have mentioned also that, we do run a CTA, and we are not always open to fresh money. But right now, I think the opportunity in these commodities specifically, and then in bond markets coming up too, in terms of, rising interest rates, and maybe even against the grain of what central banks want, I think there's great wealth creating opportunities out there in the next, 24 to 36 months. So we love to entertain any qualified investors that might be interested in our programs.
Thank you again for coming on our podcast. We look forward to speaking with you in the future. That concludes our weekend edition of the Financial Sense News Hour. To speak with our financial planning and wealth management team, give us a call at 888, that's 888-486-3939, or go to financialsense.com and click where it says Contact Us. If you aren't already a subscriber to our weekday podcast and would like to listen to more of our content, where we regularly interview book authors, industry experts, and strategists from around the globe, go to Financial Sense and hit the subscribe button. On behalf of Financial Sense News Hour and the Financial Sense Wealth Management team, we hope you have a pleasant weekend.
The Financial Sense News Hour is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the News Hour each involve their own unique risk factors, which are not discussed on the show. Responses to listener inquiries are based on the personal opinions of the Financial Sense staff and do not take into account listener suitability, objectives, or risk tolerance. Financial Sense News Hour and its parent company shall not be liable for any financial losses that result from investing in any companies mentioned in Financial Sense or arising out of the use of any material on the News Hour. Be advised that you invest at your own risk.